Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates and the impact of the government shutdown on housing. Before we start, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. I am in lovely Bergen County, New Jersey, and I had an Italian dinner last night. I mean, because I train year round and I don't eat a lot of food, if I can ever have a good Italian dinner, it's just like I am in chart heaven 24/7.
Listen, everyone loves a good Italian dinner. That's awesome. Yeah. Funny. So I'm headed to Nashville today for AIM. And are you headed home today after your
yes, as soon as I speak, I head on back. But it is interesting because we are in New Jersey, and because of the political race, the mayor race in New York, one of the questions they have is, how do we know if people leave, New York to come, and Bergen County is right on the edge, and that would be a place to go. And really the new listings data in New York, if you ever wanted to see something, then you would have a deviation from a natural curve in the new listings data in New York, and it will pop out if you saw something like this. And I kind of said, we're toward the end of the year, and this is where new listings data starts to decline, so it will really stick out. But usually people don't just like, okay, the mayor race is over, we're leaving, so it's something that you have to progressively check on a weekly basis. But if people in New Jersey are wondering if you can see if people are leaving New York and trying to get that New York money into real estate in Bergen County or anywhere in New Jersey, there are ways to track this with the Altos data in terms of looking at certain neighborhoods and certain zip codes where the new listings data starts to deviate, and that would be the first place you would see it.
Well, and our newsroom is on the lookout. Of course, Tracy Velt's been thinking about this for a couple of months since it was first discussed when Mamdani pulled ahead. But as you've said, a lot of people say that, but do they put their money where their mouth is? So we'll look. We're going to be.
Yeah, remember all those people leaving in Canada? They're like, we're going to leave to go to Canada and everything. Like one person, So that person probably came back. So yeah. It's there's migration always, and a lot of people talked about Illinois, the Illinois taxes and everything is so crazy. Inventory is going to skyrocket in the state because everyone's leaving, and you look at Illinois' inventory, it's not. So if you want to create a theory, you need a kind of a model, and then you'll see it in the data, and that's the best way to look. But it's New York. You're going to get more drama in about a few weeks, but that should be an interesting thing to watch.
Okay, we're in like the third week of the shutdown. Are we seeing any economic impact from that yet?
So a lot of people are saying, well, housing has to be impacted because the government is, so big within the natural housing ecosystem of lending. I would say this, we get these numbers every day. People throw these numbers, 1,400 transactions a day are not happening because of this. And what you really want to see is maybe it doesn't fall in today's existing home sales is going to come out, but the pending home sales report going for next month from the NAR, that is something where you could maybe pick up something where things just get delayed and they closed later, right? Okay. So you have to average it out. You remember TRID?
Oh, yes.
Yes. Yeah. Oh, did that create drama? So TRID, nobody knew that first month on how to really do it. And that was just like a nightmare at the end. But what it did is it created one of the biggest crash in sales, in history for that month, just because things closed I think an average of 7 to 11 days longer than what was normal. And then sales just shot right back up the next month out there. So, maybe the next pending home sales, next existing home sales report, you'll see something like that. And then it'll just kind of make itself back. Somebody came to me yesterday and they saw the purchase application data and they saw a 5% decline week to week. And they said, well, look, the government shutdown is impacting this. And I go, well, was there a government shutdown last year? They're like, no. So why are apps up 20% year over year?
Mm.
And then there's there's a lot of uncertainty.
Right.
Sarah, was COVID uncertain? Was there a lot of uncertainty in COVID?
Early on, yes.
Yes. Okay. So when everybody stopped hoarding toilet paper, what happened? Oh my God, it was the sharpest, fastest recovery in home sales in history. So uncertainty can maybe prevent maybe some people, but if you really believed in it, you'll really see a negative trend on the week to weeks and year over years and stuff out there. But I think the closing times is a valid premise,
Yeah.
but I quite haven't seen anything yet to make it a really big variable. So closing times, yes, but outside of that, for housing, nothing too much. I know the flood insurance and all these other things, but they're trying to mitigate that damage as much as possible.
So, and in your opinion, once the government came back, like once it stopped being shut down, then we just see a spike in all those things that were kind of being held back.
Things just work faster and all that. So we'll see what the NAR's pending home sale data. I mean, I haven't seen anything. Our pending weekly sales dipped a little bit, but we also had a holiday week, so there's ways to track this. But if this is the case, it just reverts itself back and we just go back to normal. On another note of the government, Bill Pulte, the head of FHFA, tweeted out that he's going to try to find a way with help from Barry Habib on maybe helping pricing on the LLPAs. I know a lot of people have asked about that. As soon as Trump became president, I kind of said, if they're going to go public, maybe they don't pull any levers on that out there. But I think in this case, you can see maybe something in the works that maybe might help a little bit on the margin side. So that's another government thing that could be in the works now.
No, it was nice to see Barry Habib get a shout out. I know for people in mortgage, it's like, hey, we know that guy. That's awesome.
Well, he's part of the board now. So
right.
So it's good. And also Bill Pulte tweeted out that he's going to have maybe a very constructive discussion with the home builders. I think there was a lot of maybe initial pushback on, you can't really bully ball the builders when their completed units of sales are this high and their profit margins are falling down. The government might run a business that way, but the private sector can't. They have to be careful of margins and stuff like that. So if, a lot of stuff between the New York race, the government shutdown, Bill Pulte's tweets on the government side. So an interesting week on that front.
It'll be interesting to see if they can figure out a way to incentivize the builders. Because as we've talked about, that's got to be a long-term incentive. Like whatever they do now, it's affecting them going forward. They build a house, that house is now part of the inventory that is their competition, right? So it's not just like a little, hey, we'll throw you a bone and you can build more houses.
I mean, typically you get a contract, right? You buy the land or you get an option for the land, you get a contract. That contract is demand. That's where, this is, with the builder 6-month outlook for small builders, having the spike it did, that's because of rates out there. So it's not like you can incentivize them to just build homes and then nobody buys it, out there. You need, it's a complicated business out there. So we talked about this in June of 2021. Everybody was so amped up. We're going to have a massive construction boom in America. I was like, it's never going to happen. Because for six decades, they have never done this and they never will. And I think people once rates go up, I think people are going to be shocked that housing permits were. And guess what happened? Rates went up. Housing permits are at COVID-19 recession levels. Housing starts. So it isn't shocking.
Well, I am going to our builders event. It's called Focus on Excellence. It's in Denver. The Builders Daily, which of course HousingWire acquired this summer, has this builders event. So I will be meeting with big builders in person, and it's going to be interesting. So I'll report back exactly what they have to say on this. It'll be really interesting.
Yes, and like everything, so much for me and my work revolves around the 10-year yield, right? The housing market revolves around the 10-year yield. It's I never even address it with mortgage rates first. I always move off the 10-year yield. And this week, I think the last time I checked, this early Thursday morning, the 10-year yield is at 3.99%. Again, when I get down toward my bottom end range, I've got to defend the line, and when I'm at the high end range, I go, okay, there's a lot of downside to it. So at the start of the year, when the 10-year yield was around 470, and I was like, okay, this is my peak. The economy better be booming for this to stay up here and go higher. And, you've seen, if you guys could look at a 1-year chart of the 10-year yield, it's so beautiful. Oh, that little downtrend. You take the Godzilla tariffs out of the equation, that drama mess, and it's looked, considering where the labor data is, because it's not inflation, right? It's not like the growth rate of inflation is below 2%. It's not because the treasury supply, the deficit, or, even though we had a monthly surplus, this thing has been in the works because the labor data was getting softer and softer for a very long time. And it got to the point where not even Jerome Powell and his arrogance could defend it's a great labor market. It's a solid labor market.
So from your perspective, are we about where we're going to be for the rest of the year on when it comes to the 10-year yield and mortgage rates?
The only way for me to go below 380 is that three key things. If you think mortgage rates are even going to go lower, then that's number one, the labor data gets worse and jobless claims start to break. When jobless claims breaks, it's the whole thing's over. Right? Because you can't hide that. We had a really good discussion, and I've always tried to teach people this. 1.5 to 2 million people lose their jobs every month. That's right. Very normal. That's nobody's perfect. And it has nothing to do with the economic cycle, right? It happens every month. People are not perfect at their jobs. Companies have to right size, whatever it is, they get fired. When growth slows down and consumption slows down, the hiring rate slows. So if you have to then all of a sudden see a broad economy that's consuming less, then guess what happens? You lay off more people. So when jobless claims breaks, that means that, hey, you can go lower, right? Because all we're talking about is Fed policy getting to neutral. We've never, ever discussed about the Fed policy ever getting to an economist stance, but the 10-year yield can go there. So obviously, that hasn't happened yet. Number two, there's always this stock market money can flow into the bond market, kind of like last year. Last year was a good example. Hodor got broke. Hodor, right? Am I saying it right? Nobody's bothering me about it anymore. So
I think that means you're saying it right.
Yeah, okay. So that broke, and I was like, okay, I don't think we should be here, but the markets can run you over at times, and then we shot right back up. So the stock market could be one. Third, the Fed gets dovish, right? Jerome Powell is coming toward an end. Whoever the next Fed chairman is, and other Fed governors say we would like to have we'd like to get to neutral, stay in neutral, and then maybe think about being in an economist stance. Those things can, maybe get you under 380, but we've priced in a lot. Yeah. Right. And this is why we brought Hodor out at the end of 2023. We had the Gandalf line. We always say these levels, boy, because 65 to 75% is Fed policy. So you need things to happen. And if mortgage spreads were back to normal, then you're at 5.75 already today, or even lower than that. But I'm almost at the end of my mortgage spread improvement forecast. It's already got to the peak. I think 0.2 basis points away from the peak level of improvement. So everything kind of already has been priced in for my work. So I need to see other things to happen to get the 10-year yield below 380, to see if mortgage rates go below 5.75. But we're just here, and considering what the labor data was doing, it kind of makes sense.
Of course, we don't have the big jobs report this Friday, but we do have apparently the CPI report. Apparently, the Trump administration has said, "Hey, yeah, let's go ahead and release that." Not sure how that happens. Could that change the game here?
I mean, trajectory-wise, no, but I really want to see how the market reacts to this report after this big move, right? If the 10-year yield's at 450, it's different. But since I'm at the low point of the level, I'd like to see how the trading goes off of that, because Oil prices are down. Labor data is getting softer. These aren't things that usually you see in a booming economy that inflation is taking off because demand is going crazy. The U.S. has the most awesome consumer base in history, but goods inflation is picking up. We see that in some of the goods pricing. Service inflation is slowing down to a degree. So I really want to see but what do you think about the CPI report with who knows who's working, So it's a conflicting time because the quality of the data and what's going on, you just don't know. So we'll see. It is interesting that they made sure that this report comes out because the Fed meets next week, right? And that's, there's only 2 more Fed meetings left for the year, and the market is really priced in 2 rate cuts for the thing. So again, so much is already priced in already, right? This is like kind of as good as it gets, but you need other things to take it to the next level.
I think we always come back to this though, like with the inflation report, like you've said, well, if they want that to come out, then it's reasonable to think that they think it's going to be a good report. But a good report might not be good for mortgage rates, right?
No, a good report is good for mortgage rates.
Okay, but, so when you
when I say it's a good report, that means the growth rate of inflation isn't going to meet estimates. Right?
Okay.
So that's a bad report is that inflation is higher than what they expected. So that's when I mean a good inflation report, the growth rate is slowing down, not picking up out there. So it's interesting in that stuff. And then, of course, we're going to have existing home sales in about like 90 minutes. And sticking with the theme that we brought back about 4 or 5 months ago, we said if home sales just stay flat around 4 million, that we should see growth year over year from the reports that happen in June to October that will be reported in July and November. So for the most part, that's happened. It's because we're working literally from the lowest bar ever in history. So you got to take that year over year growth with a kind of grain of salt. Our data is showing slight growth year over year on the weekly pending. So that finally filtered itself into the recent existing home sales report. So if you get around that 4 million level, just remember, you see the year over year growth, just remember last year was historically bad in terms of total existing home sales. The forward-looking data with purchase apps, the first half of 2024 was one of the most negative weekly curves I've seen. Even though home sales weren't crashing or anything, we weren't going anywhere, and it created a sub 4 million trend. It wasn't very big underneath 4 million, but it was enough that it doesn't take much to move the needle. So the year-over-year growth we see is, and take it with a little bit of grain of salt, and we'll just move on forward once the government shutdown ends, and then we balance everything out and everything can close on time, and we'll take it from there.
Yeah, never a boring day, Logan. By the time we get off of this, something else could happen. We always say that, but it's true, especially in this administration. Like, things change fast.
This is why you need me 5 days a week. 4 days isn't, when it comes to the end, Sarah, I'll be on 7 days a week, probably be twice a day. We slowly work. It's funny because I talk to people and say, yeah, you used to be on once a week. Yeah. And I was like, yeah, 2, 3, 4, eventually 5, 7, twice a day. And then that'll be a lot of fun.
It's just going to be the Truman Show, only the Logan Show. We're just going to follow you around constantly. It's kind of like that already with social media. So, yeah, only you'll know it. Well, Logan, thanks for being on. Appreciate you, especially when I know you're speaking today. Thanks for making the time.
Pleasure.